It's Brian Preston, the Money Guy.
Okay, John Brew says, wife and I are 29 and buying my parents' home for half the market value.
That's a sweet gig.
First of all, congrats on that.
Did you see how mad our entire content team just got right there?
His question is, should we still put 20% down? Considering putting less down, they're on step 7 of the FOO, and we do not itemize, he says.
Well, first of all, John, I mean, because they say that this is their first house?
He said he's 29, so I don't know.
I mean, well, the typical home purchase date is 33 now in America, so 29 is still very early. If this is your first house, John, I mean, typically, we only recommend 3 to 5% on that first house because there's so many other things vying for your dollars that we try to give you as maximum flexibility. And the reality is, if you're getting a house for 50% of market value, even if you only put down 3%, you're essentially putting down 53%. I mean, it's kind of incredible how good that opportunity is. So I give you that latitude, but it does fit into, go through the financial order of operations, see if you're making sure you're not leaving behind the emergency reserves, the Roth and HSAs, the maxing out your retirement, because you said you're at step 7. Mm-hmm. So that means you're already making tremendous progress on this. But I would say at age 29, still every one of those dollars is so valuable that maybe you're also moving on to step 8. I don't know. We didn't hear if you have children. We didn't hear, if there needs to be some college savings going on as well. But I think that you're in a great situation that I would take advantage of that maximum flexibility that we give you to put down less, because then your decision making is kind of getting towards step 9 of the financial order of operations. Is it, do I go and take a loan or pay down that loan? Because that's really what you're doing when you put down 20% is you're paying down low interest loan. But since you already have 53% at a minimum equity, that's kind of hard with everything that's going on.
Yeah, the other thing, we don't have context. If are your parents selling you a $2 million house for $1 million, or are they selling you like a $300,000 house for $150,000? Because the economics of that matters. Because one of the things you can't waver on, even if you have a ton of equity in the house, you need to make sure that your monthly mortgage payment does not exceed 25% of your gross income. So if only putting down that 3% on the house is going to cause the monthly mortgage payment to be something that's going to cause a problem for you, I would think about, okay, do we need to end up putting more down so that we can make sure we keep that guardrail in the right place? Now, getting a 50% deal is still an amazing deal, and it gives you a lot of flexibility, but you want to make sure that from a cash flow perspective, you can still afford to service that debt if you do take a higher amount of debt than you're otherwise thinking of.
And then this is something off the cuff. Is this mortgage assumable? Is this something, because you have the ability, since this is a transaction where the seller well, you might be able to go to have the time. One of the things that we don't have in this current market is that most buyers don't have time on their side. Mm-hmm. That goes for due diligence periods. That goes for figuring out how you're going to get all your financial resources lined up. It sounds like you've got love and consideration is going into this deal a lot. So you have the ability, you have a good benefit there that most don't have, is that you have additional time that you can go research, cool creative options like, is this mortgage assumable? So that maybe even get that historic low rate as part of the deal. There's lots of things that you just ought to do a little more due diligence and research on, because your parents are really setting you up with a tremendous opportunity there.